The good news is the world is very different today from a technology perspective. One of the reasons that 1929 ever even happened was literally the stock exchange was oftentimes off, meaning the numbers that you saw on the big board were 3, 4, 5 hours behind the actual numbers. And as a result, people were just selling indiscriminately because they just thought the whole thing didn't even work. I mean, one of the reasons you always see those famous pictures of people down the New York Stock Exchange in 1929, the reason they're there, the reason they're all in the street is these are people who've come from all over New York and the rest of the country to try to find out like what's happened to their money. So that piece of it you take off the table because you can get the numbers right here and off of your terminal and everything else.
Right.
There's an SEC. Insider trading is not legal. It was legal then. So all the manipulation that was taking place. There was no FDIC. So you had bank runs that took place in the aftermath of this crisis. We could talk about Glass-Steagall and what that either represented or didn't, or whether you think it's come back or not. But here's a bigger one. Capital requirements for banks. There were none. Zero back then. So there's a lot of reasons you'd like to believe that we can't have another crisis of the magnitude we did. And by the way, it's also worth noting, the crash in 1929 wasn't preordained that when that happened, that we had to have the Great Depression. That was really the first domino of a series of dominoes, and then a series of, frankly, terrible policy choices. The Federal Reserve basically doing nothing, the implementation of tariffs. We can discuss what that means today.
Right.
There was a gold standard, so there was a question about how much money you could throw into the system, austerity, all of that worked against things that led to 25% unemployment. Didn't have to happen, if you will.
I have to say, that was one of the things in reading your book that I was like, wait, I think there was just an assumption that it was the market crash that caused the Great Depression. So it was really
everybody thinks it's like there's one bad day,
right,
and then somehow there's a Great Depression, but there's so much in between.
Listen, so many people on your book tours, like everybody's like, can 1929 happen again? And I do wonder, is there a better, smarter question that we should be asking you, having done all this research and taken us back there, making us feel like we were in the room when it happened, that we should be asking you?
Well, look, it didn't happen.
Rather than can 1929 happen again?
I'll tell you, I'll give you actually how you could get to 1932 today, and that sort of maybe speaks to this. So one of the lessons that came out of 1929, it was actually the lesson that Ben Bernanke learned when he was doing his great his thesis on the Great Depression at Princeton, is when there's a crash or a crisis or a panic, the playbook is to throw money at the problem. Maybe politically unpopular, but that is the lesson. And he did it in 2008, and by the way, we did it again during the pandemic. And I think we now think that there is a playbook, and by the way, there's also therefore a put on the market, because we now have the playbook. The one thing that's different this time is if you genuinely believe every financial crisis to some degree is a function of debt, too much debt in the system. So far, we're all talking about corporate debt, really. Back then, there was, in 1929, there was a budget surplus in America. Now we have $38 trillion. The question is, let's say we have a crash, and the government says, we're going to write a check for $5 trillion. That's the put. And whether you believe that there is some kind of invisible line that turns into a red line for the bond market, where they say, you know what, we like you guys in America. We're happy to lend you money at 3 or 4 times the rate that we do today, and that's the interest rate you're going to pay. And then all of a sudden you actually do get into some kind of austerity spiral, and then you're living at a 25% unemployment rate in the country. When you really sort of try to get through the permutations, how do you get there? In this day and age, that's one way. The one other thing that's interesting today is the technology, as bad as it was then, in some cases could even be too good today. And I think we learned that with the Silicon Valley Bank failure, where someone goes on Twitter and says, I'm pulling my account. Now, that information is accurate.
Everybody does it over the weekend on their phone.
Everybody does it.
Right.
I used to think, this device is so great because if there was a bad piece of information, it could be corrected very quickly. But if there's a accurate piece of information that's not good.
Right. People act on it quickly.
Well, so let's talk more about the technology today and sort of parallels and the idea of maybe irrational exuberance and signs of irrational exuberance right now. In reading the book in the 1920s, there was certainly a lot of that, but it seemed like it was, more on credit and people buying on margin. Nowadays, there's the idea of crypto. Some of that has been kind of pulled back in just a couple of months, actually, since you published the book. We've seen
but
some
by the
stocks
way, there
falls.
is a lot of debt in the crypto market. I mean,
Right.
shocking amounts
Okay.
of leverage.
So there's that side of thing. There's prediction markets and sort of the money
Totally.
that's going into those, the excitement around those. The private credit and concerns about private credit that we've seen in the last couple of months. Any signs of anything there to
Well, look,
you?
the private credit business has always concerned me because of the transparency of it, or frankly, lack of transparency. I think if you were to talk to Jay Powell, he would tell you that, even the Federal Reserve doesn't have a full grasp of how interlinked all of the debt and credit is in the private credit market. Having said that, depending on what numbers you're looking at, you could argue it's only $2 trillion. $2 trillion is a lot of money, but it's not the entire market.
Yeah.
And
It's not systemic.
So I don't know if it's systemic.
Right.
By the way, I might worry more today about short-term treasuries. I mean, by the way, the United States, have been trying to sell short-term treasuries like crazy because we think that we can get a cheaper rate that way.
Right.
That's also a much more complicated place to be if, in fact, you actually have to pay it back more quickly.
One of the questions we were kicking around when we're thinking about having our discussion with you is Wall Street greedier today?
I don't know if it's greedier
And
today.
is
Frankly,
greed-
I would argue. Greed. I think
And
there's
is greed bad necessarily?
I think the lesson for me of writing this book in some ways was that they didn't use the phrase back then, but this idea of FOMO.
Yeah.
Which, by the way, is driven in part by this phone and TikTok and people seeing all sorts of things. And by the way, I think makes inequality actually. And I don't know if it makes it worse, but the perception of it and just the visibility of it.
Right.
But I do think the sort of FOMO, greed, envy, I think that's what's driven people for the test of time. And that's what it is. Is it worse today than it was before? I don't know, except, and maybe this gets to the inequality piece, I think there are more people who think that they are effectively unable to actually make it, and therefore more willing to take risk and more willing to sort of try to grab this lottery ticket as opposed to sort of make it over time slowly.